Most people think investing is about intelligence. They believe the smartest person in the room wins. But after more than 70 years in the market, I've learned something very different. The biggest fortunes are not built by the smartest investors. They're built by the most patient ones. If you can control your emotions while everyone else is losing theirs, you already have an advantage over 90% of investors. Today, I want to share with you the principles that quietly built my wealth. Principles that anyone can follow, even if you're just starting with a small amount of money. And if you truly understand these ideas, you might never look at investing the same way again. The investor's struggle. Let me start with something honest. Most people don't fail in investing because they lack information. They fail because they lack discipline. I've seen investors buy stocks because everyone on television is excited. I've seen people panic and sell the moment the market falls. And I've watched countless individuals chase quick profits, only to destroy their long-term wealth. The truth is simple. The stock market is not a place where the smartest people always win. It's a place where emotions are constantly tested. Fear, greed, impatience. These three emotions quietly sabotage more investors than bad advice ever could. So before we talk about strategies, you must understand something important. Successful investing is not about predicting the future. It's about behaving differently from the crowd. Let me show you how. Lesson 1. Think like a business owner, not a trader. When most people buy a stock, they treat it like a lottery ticket. They hope the price goes up tomorrow, next week, next month. But that's not investing. That's speculation. Whenever I buy a stock, I ask myself a very simple question. Would I be comfortable owning this entire business for the next 10 years? Because when you buy a stock, you're not just buying a ticker symbol. You're buying a piece of a real business, a company with employees, products, customers, and long-term potential. If the business is strong, the stock will eventually reflect that strength. But if the business is weak, no amount of market hype can save it forever. This is why I spend most of my time studying businesses, not stock prices. I want to understand how the company makes money, why customers keep coming back, and whether that business will still matter 10 years from now. When you start thinking like a business owner, you stop worrying about daily price movements. And that's when investing becomes much simpler. Consider funds. Lesson 2. The power of patience. Let me tell you something most investors hate hearing. The stock market rewards patience, not activity. Many people believe successful investors are constantly buying and selling. But the truth is, some of my best investments required doing almost nothing. In fact, if you look at my career carefully, you'll notice something interesting. Most of my wealth came from just a handful of great decisions. Not hundreds, just a few. But those decisions had time to grow. You see, time is the most powerful force in investing. Compounding quietly multiplies money year after year. But compounding only works if you allow time to do its job. Imagine planting a tree. You wouldn't dig it up every week to check the roots. Yet that's exactly how many investors behave. They check prices constantly. They react to every market headline. And they interrupt the very process that builds wealth. If you can learn to sit still, while others panic and chase trends, you'll already be ahead of most investors. Lesson 3. Buy great companies at fair prices. People often ask me, should I buy cheap stocks? My answer usually surprises them. I would rather buy a great company at a fair price than a mediocre company at a bargain price. Because great businesses have something powerful. They have what I call a competitive advantage. Maybe it's a powerful brand. Maybe it's loyal customers. Maybe it's a product competitors struggle to copy. But whatever the advantage is, it allows the company to keep growing for decades. And when a business keeps growing, your investment grows with it. A weak company, on the other hand, can stay cheap forever. Price alone doesn't make something valuable. Quality does. So instead of asking, is this stock cheap? Ask yourself, is this business exceptional? That question will lead you toward much better investments. Lesson 4. Be fearful when others are greedy. Markets move in cycles. Sometimes people are wildly optimistic. Other times they are deeply afraid. And those emotional extremes create the best opportunities. One of the simplest principles I follow is this: be fearful when others are greedy, and greedy when others are fearful. Now, this sounds easy in theory, but emotionally, it's incredibly difficult. Because when markets crash, fear spreads everywhere. Headlines become negative. Experts predict disasters, and investors start selling. But that's often when the best opportunities appear. Think about it this way. If your favorite store suddenly offered everything at a 50% discount, you'd be excited. Yet when the stock market offers the same opportunity, most investors panic. Successful investing requires doing something uncomfortable. You must remain rational when everyone else becomes emotional. Lesson 5. Protect your downside. Many people focus only on how much money they could make. But experienced investors think differently. We ask a different question. How much could I lose? Because avoiding big losses is one of the most important parts of building wealth. If you lose 50% of your money, you need a 100% gain just to recover. That's why I always emphasize protecting your downside. This means avoid businesses you don't understand. Avoid excessive debt. Avoid speculative trends that rely purely on hype. You don't need to swing for the fences in investing. Sometimes the smartest move is simply not losing money. And if you follow that principle consistently, your portfolio will quietly grow stronger over time. Lesson 6. Simplicity beats complexity. Wall Street often tries to make investing sound complicated. Complex models, endless forecasts, sophisticated predictions. But the truth is, investing doesn't have to be complicated. Some of the best investments are surprisingly simple. Strong companies, good management, growing demand, reasonable prices. That's it. You don't need hundreds of stocks. You don't need to monitor markets every hour. And you certainly don't need to predict the economy perfectly. Instead, focus on what you understand. Stay within your circle of competence and keep your strategy simple. Because in investing, simplicity often beats complexity. Lesson 7. The real secret: emotional discipline. If there's one lesson I want you to remember, it's this. The biggest advantage in investing is not intelligence. It's temperament. The ability to stay calm, to stay patient, and to stay rational when everyone else becomes emotional. Markets will always fluctuate. Prices will rise. Prices will fall. But if you remain disciplined, you allow time, businesses, and compounding to work in your favor. And over decades, those forces can create extraordinary wealth. Closing thoughts. Let me leave you with a simple perspective. Investing is not a race. It's a long journey. You don't need to get rich next year. You need to build wealth steadily over time. Focus on strong businesses. Stay patient. Ignore short-term noise. And most importantly, keep learning, because the greatest investment you can ever make is in your own understanding. Soft call to action. If these lessons helped you think about investing differently, make sure you subscribe to the channel. Because here, we focus on the timeless principles of wealth building, not short-term hype. And if you want to keep learning how the world's greatest investors think, watch the next video on your screen. It might completely change the way you approach money. Thank you so much. Stay connected.